But in the short term, I
Sorry.
think we still have to figure out, essentially what is going on with how much further down the market has to go, or if it's reached its bottom already. And one of the things we saw in the letter this week and talked about was that there's actually been a pretty strong movement up since the Silicon Valley bank blow up. And as we look back at it, we could look at that as like a pretty clear end. But I do think we still have to see some of this macroeconomic data come in, which showed very strong, surprisingly strong jobs report on Friday. So I think part of what we saw there is the market saying, hey, we might not have as bad of a recession as some people were expecting. But right now we kind of have some, mainly having some of the traditional tech names that we see that we think are kind of due for long-term recovery, and this might be a really good time to get in. And then other than that, we're trying to look at kind of like opportunistic shorts that I do think there'll be kind of more opportunities for until we get kind of into a strong bull market again, which either way, I think there's some time until we see that.
Do you have any opinion on if there's too much weight on the couple big names of big tech, if they're holding up the market and if they were to turn downwards, everything would go, or if there'll be a counterbalance where if those sell off a little bit, everything else will come up? Because I saw recently, I think there's one of the biggest divergences between IWN and this NASDAQ. So do you have any opinion on that?
I think one of the things that we saw is that we actually saw kind of bigger names. And if there's a way, who's screen sharing? I think one of the things that we saw, I think I can actually screen share, and I'm going to do it in the app a little later too. But there's a great graph that I shared in. Oh, I think you have to enable my phone as the host.
Okay.
But that basically is showing that there has not really been a great recovery in small caps yet. And traditionally, you see those in like when inflation is decreasing. You basically see like a lot more evidence of that kind of of that kind of behavior. But what we'll see here is here, let me just pull it up from the newsletter this week. Is basically, I think this graph actually shows it really well, where we're looking at basically how well the S&P 500 recovered from, kind of like what we're just talking about is like perhaps a strong bottom to this for SVB. But, things lower, or obviously the Russell 2000 overall, has not seen the same recovery. So I do think what we have seen is it indeed being carried by stocks that we're talking about and we're recommending right now, like Amazon and Meta, that kind of got hammered pretty hard to what some might say like are relatively attractive PE ratios for those tech stocks. And I think especially Meta got hit way too hard based on some bad business decisions, which is kind of understandable. But now that they're moving into a more hot space like AI, I think people started to value them based on what they're earning a little more accurately. So yeah, I think to your point, we are seeing kind of the big tech names, especially, starting to come back. Even with Apple did well, even what some might call disappointing earnings, but I think their guidance was very reassuring. So I think what we are seeing is recovery there, but I think the fact that like kind of small caps have a further distance to move up right now doesn't change the fact that I think these larger stocks are also still attractive, even though they are going to be the first ones to recover. I think they're the first ones to recover for a reason, because those are the ones that you can hold for 10 years from now, wherever it looks like the next bear cycle is coming, and be confident that you'll make a very, very nice return for the risk that you're taking on. Whereas like with some of these small caps, if we do see, we are getting good inflation data coming in, But if we do see kind of, especially with these strong jobs reports coming out, if we do see kind of a more persistent inflation than the more the market might be forecasting right now, it might be a risky time to get into those. So I think that's a roundabout way of saying that, like, I do think big tech might be carrying, or like, big companies, safer company might be carrying us a lot right now, especially as those tech companies that got hammered. But I think it's for a good reason, and that's not a good reason to avoid them. But yeah, there are what look to be like great buying opportunities in the smaller cap stocks now, and I would say might be early for me. It looks like it might be a little early for this other person that we kind of quoted from this Wall Street Journal article. But early is sometimes the best time to make your big profits. So if you already have a very diversified portfolio, you're looking for, kind of some long-term bets. Maybe that's a good goal for next week. We can come on. I haven't really prepared for that specifically, but we might be able to talk about some of our favorite small cap stocks next week.
Awesome. And since you have the newsletter open, maybe you can talk about how you choose which stocks you're going to add into the newsletter and how you format it.
Yeah. So I think how it goes a lot of the time is, unless we have a particularly interesting stock pick, what we'll do is we'll put kind of the market level on top and kind of set the stage there. And basically what we're seeing on the market level right now, and we wrote about, was that basically, especially in SPY net option sentiment, you see it kind of like way below our bear zone there. It was definitely not as excited about the run on Friday as, especially if you see QQQ right below it that moved into kind of more neutral territory on Friday from the bear territory. And this is kind of what we've seen a lot of this year, that that the SPY net option sentiment is definitely, leaning more towards the downside and has led, really well there. But the QQQ net option sentiment has also led some rallies a little more, as SPY, can traditionally be a little stubborn, even though we have seen, if you look at it kind of in that second arrow here, there's three pointing from kind of the top of the text, and you do see it on a nice lead up on the upside as well. So I would say kind of that was one of the reasons that had me cautious there. And then, as I kind of alluded to broadly, what we'll look for, especially now, always are stocks with a good risk return. And Amazon, we've been watching, it beat SPY a little, this week. Overall on the year, we've been very strong. I would say picking it at over 70% accuracy on our, bull and bear picks blended together. And what we're looking for here is like, yeah, basically to your point, we're starting to see some evidence that these large cap tech stocks are finding their bottom. And for me, I always want to report on that kind of stuff and get people into that, because, what's great about these stocks is like, I'm very comfortable with the downside protection, especially kind of like looking like some of these stocks found the downside, and Amazon went as far down as like, I think 80, 85. And Meta is another good example we'll get into below. But yeah, like if I can recommend a stock that I think could have good short-term appreciation and good like long-term risk metrics, and obviously, Amazon looks very good both in the short and long-term metrics for good reason, that would be my first preference. But as we get into kind of these shorter term ones, I think it's a good example of the reverse. And with bear picks, it's very difficult, other than what we saw, a few years ago, where it's just like you've got a bunch of overvalued tech. It's kind of hard to find, what you would call a stable bear pick or a stable short. Because a lot of it's very momentum. You can have people cover very quickly and move on to, the next attractive short. So when I see something like Sonic, and it's done pretty poorly today, so this looks like it's going to be a good pick this week. Essentially what I'm looking for is what you see here. Lower trending net option sentiment, lower trending upside breakout, higher trending downside breakout. Those are the ones that are kind of like our hero metrics that are largely defined from the options pricing. So that we basically see in both, short term for net option sentiment, and then long term for upside breakout and downside breakout options markets. So that's my preference, to find something that has this kind of setup. And what I'll do is every week, if the ones that I had with my prior bear picks don't have that set up, I'll just look for new ones. One of the interesting things that we saw about Meta is it was in a huge bull pattern, and Meta, as you can kind of see in this picture right here, in kind of the three pictures, it's the one on the right, and it has been fixed at the top of our upside breakout at 100 for longer than I've ever seen a stock, meaning that the long-term options markets have been consistently more bullish on Meta. And I actually looked at this yesterday, since February 16th. So since it's been fixed at 100 on our scale, it's been up 34.7%. So, until we see that change, we're probably going to stick with Meta, because the long-term options markets seem to be so sure that they want to price calls above, calls above where it's trading to puts below where it's trading, which is a lot about how we look at like options and pricing momentum. So we definitely stick with this, and it's tough because sometimes we look at it and say, okay, there's this news event that looks like it could cut into it a little bit, but like as long as our metrics remain this strong for something, we're going to keep it on our watch list. And we did see that with Amazon. It had a bit of a rougher week last week when there was some news that the cloud might not be as good. But then this week it was back to beating the S&P 500 by about 1%. So we tend to stick with it as long as we have, those kind of metrics. And then Packaging Corp was another one where I basically saw, some decline in, what we call like key metrics, especially net option sentiment. You kind of see it in an overall downtrend, and we kind of identified that in the averages about 10 points below the last 3 days than we'd seen it, about the previous 7 business days. So these are the kinds of trends that always stick out for us. We like seeing something like high upside breakout, like 87, and low growth. But a lot of this is just me like looking at a bunch of different setups. A lot of the time looking at these setups in the app. And we'll kind of just talk before I can look at that a little bit. Because one of the things that we did is we did have 2 more wins. We've been doing it at a high clip, and like NTRS is a really good example of one that like we probably would have kept traditionally, but it's in the finance industry, and we're just like, we think there might be more support for that, so we kind of cut it out. We're going to take our 6% weekly gain on that one all day long, unless we're really sure that we want to stay in, and it was too mixed. And then NSA is another one that actually the metrics dictated that we might have want to had it in, but like basically it reported last week, and I thought that report was going to decline earning, like I thought that poor report was going to decline the stock price a lot more than it did. And when I didn't see that, I was pretty uncomfortable with leaving it in. And so, basically one of the things that we wanted to look at as well is another stock, and talking about how like AMR, it's on the top of our short-term list right now. And actually, when you look at it, we actually talked about it in our Twitter last week. I believe. Apps.
Yeah, I saw that tweet a couple days ago.
Yeah. So it has been up over 10% since we basically saw. And like what I really love about what we're able to do sometimes, and obviously this was early on Friday, and it's up almost 8% today, and the rest of Friday was a really good day for it. And like this is just what we're talking about. Like AMR is a very, very strong long-term pick, very high profitability, nice upside breakout relative to downside breakout. But then when we see this kind of behavior where it's spiking in both net option sentiment and net social sentiment, that's kind of a slam dunk for us, because option sentiment is one thing, like we expect institutions to kind of be ahead of the market sometimes. But if social sentiment is there too, it kind of means like that's something that we look at, especially like for something like Tesla. If we see that, we're not necessarily all that excited about it because a lot of people speculate on that all the time. But when we see it for a less big name like AMR, that's kind of what makes us want to write about it. And it kind of remained pretty strong there too. You see it very strong in the short-term signals as well. even lower downside breakout than when we looked at it before. So yeah, that's the kind of thing that we really want to bring people's attention to. And I would say that's a good rule of thumb. Like if you look at the rest of the ones in our attractive short-term list right now, you're seeing a bunch of names that you would expect to see there and like, will frequently gain, especially like Rocket Lab is something that I've seen up in there, especially social sentiment a number of times. So I'm not surprised to see that one. And then you got like a bunch of big tech names there as well. But like, yeah, I would say anytime you see something like this, AMR, if you haven't heard of AMR, that's kind of even more of a reason to take it seriously. And personally, I discovered AMR on Prospero. So I've been watching it for a bit. I've taken it for some runs myself. But that's a really good example of, a stock that, and I would say the biggest reason I didn't put it in the newsletter is like that 9 growth right there. And I kind of only am running about 2 bears and 2 bulls a week. So a lot of the times things don't make the cut. But like, obviously, if you just look at like what it's up against, if you look at Meta, Meta still has 82 profitability, which is kind of close to AMR, but then 57 growth. So that's an easy way for me to say, and it's still lighting up in kind of a lot of the short-term signals the same way. So it would be very hard for me to bump Meta in favor of, AMR as much as I liked it and I wrote about it on Twitter. And like Amazon is another really good one, still 58 growth despite 53 profitability, lower on that, but still really good and high institutional flow as well. So, that's kind of the process. Some weeks it really stands out which two and they're head and shoulders above the rest. But I think this week was a really good example of I would have loved to put AMR in there. But there kind of was not enough room given that I'm bullish on Meta and Amazon pretty consistently right now, as well as kind of what I was talking about before, which is like if I see an attractive kind of like blue chip stock with great long-term potential that is flashing well in the short-term signals, it's hard for me not to feature that.
So that's in the weekly newsletter that anybody can get, but you also have a bi-weekly subscription-based newsletter. So would a stock like this fall be mentioned in there possibly more likely since it's more in depth?
Yeah, yeah. I kind of like explicitly cover different stocks in that one than I do, and one of the things that helps there is I'll cover a lot of specific option strategies, and that's actually one of the big reasons that it's a paid newsletter versus another free newsletter, because like I don't necessarily want to be exposing everyone to kind of like I do strategies to sell puts or covered call strategies, or sometimes we even did a volatility straddle where you're essentially buying calls and puts because you expect it to just move in one direction. Either in either direction big you'd make money. That's what that kind of strategy employs. So yeah, some of these are a little more specialized, and I'll cover more stocks, and I go into a little bit. I can actually pull that up. One of the things that we do is look a little more broadly at like movers. So if you look, this is a list that people don't see in the here, this one's got a little that people don't see in the other letter. And that's just because we're basically, these are kind of like shorter term trades, and sometimes I'm just like looking them in and out in the same week. And this, we're basically like looking at, basically in this sense, the biggest options movers down. So we basically frame it by saying like, okay, from a 1-day change, which one are the biggest option sentiment movers? And obviously things like that, to my point, are more advanced tactics to employ. So it's kind of just a different energy, but we're using obviously a lot of the same logic. Just like, yeah, I don't necessarily like if I'm going to be teaching more advanced strategies, I want to make sure, again, if I gated it a little bit of a higher price, I think that kind of helps make sure that only people that can afford to lose money on these more complex strategies are going to have access to them.
So if this is something that's interesting to people, where can they find how to sign up for this newsletter?
Well, I share it. It's at the top of my uh normal newsletter every, oh, that's the wrong one. So yeah, every week I'll put it right here. Like, yeah, you can see it's at the top of the other newsletter. I don't want to like bombard people with it too much. Sometimes I'll put it in different places or I'll link to it in a place where I like specifically want to follow up. But yeah, that's a slightly different flavor, but like a good way to even get more of my commentary during the week.
All right, so if we could switch to a little bit more macro. So I believe JP Morgan just was the bank that received all of First Republic's assets and they were able to get a pretty good deal on that. So it brings up an interesting debate of how these big companies keep getting bigger at the expense of the little guys, it seems like. So could you talk about that whole situation?
Yeah, I mean, I talk to a lot of retail investors, and I'm quite skeptical myself about these kinds of things. And I think the people that talk to me longer, I was almost proud to hear them say like, "Oh, this looks like they're consolidating, like maybe like a larger like conspiracy where these banks just keep getting bigger." And I mean, I don't even think it's that big of a conspiracy. I think we keep on seeing like consolidation in any industry that we follow. And I think it kind of brings up a more interesting point beyond consolidation, which is that I feel like often in this country, when socialism is talked about for, say, medical care or a lot of things that developed countries tend to have and give to their people for free, like single payer health, it's said no, we can't afford that, and it's like a dirty word, and socialists are dirty, but when it comes to what happened with JP Morgan, which they took a one-time profit of $2.6 billion as basically like a bribe to acquire First Republic, or a financing bribe to acquire First Republic, all of a sudden socialism's fine in that capacity and nobody talks about it as such, but it is that. It's definitely not the free market. And actually, if you pull the thread a little more, it gets even more offensive, where you see that Mark Zuckerberg was one of the people that got a 1% loan from First Republic because they just wanted to acquire accounts of wealthy people. So you basically have a bank issuing loans that they shouldn't as a form of customer acquisition, which is one of the biggest challenges for banks. But in making all these loans, they developed a toxic asset base. And in order to clean that up, another bank has to be bribed and make a huge profit to clean up that mess. So it's like socialism for Mark Zuckerberg, socialism for JP Morgan, a bailout for the First Republic people. But anytime it's talked about it for someone else, the country can't afford it because they can always seem to afford these structures. That's socialism for the rich. And I would say the other part about that that's particularly interesting is everybody said First Republic is great because they have all these great large accounts. And that was one of like their big asset bases. And JP Morgan, in the end, would love to acquire those accounts. And they pay tons of money every year to acquire new accounts and ads and incentives and everything like that. And they just got this huge set of attractive accounts, and they were paid by the government to acquire that huge set of active accounts. Like, yeah, there is some work that needs to be done to unwind the bad assets, combine things, move things along. But that profit was above all the expected costs. That was one-time accounting profit that basically incorporated a lot of these costs into that acquisition and the net value of the expected transaction. But even if some of that's going to be eaten into it, it's a huge benefit to them. And basically, the big thing there is the government got involved. Bankers knew that they were desperate to have this acquisition, and I would bet that it could have gotten done for less. But the government often tips their hand, and everybody knew how much the government really needed this to happen, so it didn't spread, and JP Morgan got a huge bounty from that. So I think that's really the type of thing that you see and you see it happening more and more, and that's one of the problems that Prospero was built to solve. because I'm not even saying that we should have single payer health, or that we should just like build in whatever whatever system is going to work. But what I am saying is it's offensive to me to hear that we don't have money for all these things that are essentially taking care of everyday people, but then we always find money to bail out banks and even subsidize operations that are giving discounted mortgages to billionaires. That to me is pretty offensive.
Yeah, the little guy's always getting hurt in these situations, it seems like. But where does this leave the state of regional banks? Do you think there's still pressure for a lot of banks out there?
Yeah, I mean, I think I did see some rumbling about like, shorting to stop on the banks. And I think the other, like, I would expect like people close to the Fed with contacts, I suspect institutions were strongly encouraged over the weekend to stop shorting banks. Um, but then again, who knows? Which is it's kind of these perverse incentives we're talking about. They could short them and then be able to buy more asset bases at government subsidies. So you never know. But I do think that it's like, yeah, it does seem like a lot of these, like a lot of what's happening, same with Silicon Valley Bank, was basically just like giving far too attractive loan terms to acquire customers. And I would expect that to not be the case in some regions. Like, I don't think it's any mystery that like both of these are like San Francisco banks. And I think if you go to the Midwest, you probably have a little more kind of conservative banking that happens there than happens in San Francisco, where they just assume that the IPOs were going to keep happening and the large checks would keep coming in. But yeah, I think that we might not be on the other side of it. We might see more collapses. But I think that's just a question of variables that are very hard to understand, whereas just basically like what we're talking about. I think if institutional buyers were either convinced or want to stop the bleeding here, like all that has to happen is there has to be some price support on these stocks. A lot of these stocks like are basically going through the same death spirals where the price will get hit, more people will pull out their deposits, and then the price will get hit more. And then, that's the same death spiral we've seen. Uh,
So
so yeah,
essentially, it seems like you're saying that some of these bank crises are manufactured by shorts.
you could say that, or just everyday people. I think it's a combination. But yeah, I would say that like you see these banks shorted, you see other people, you basically see selling pressure larger than buying pressure. That causes more, retail or other holders to get out. And I absolutely think that some of that, whether or not like again, if that's like the conspiracy and it's like to acquire assets at a discounted price, I don't know if I want to say that was the plan. But like, yeah, like these assets were overvalued, or these balance sheets were basically in bad shape. I think that like unfortunately we have no real fix um for essentially what is other banks having inside information on this. And to the extent that it could be shared or what have you, is speculation. But if say Goldman Sachs is figuring out if they want to do business with some large regional bank, they're going to have their own asset tests, they're going to have their own risk tests. And basically like, what happens with a lot of these things is that Goldman knows the real value of these assets, or another large bank knows the real value of these assets more than the bank itself does, that doesn't have the same, what's called mark to market abilities. And just for anyone that doesn't know what it is, mark to market is heavily involved in pretty much any banking crisis, because basically you have these assets on your books marked for a certain amount. And then, even using the mortgage crisis is the easiest example, where you have all these mortgage-backed securities on your books and you have them close to the value they were originated at. But as defaults start to happen, you have to mark those securities to market, because you basically have to say, oh, at these default rates, or with prepayments slowing down, X%, all of a sudden, all of these securities are worth less in like a discounted cash flow, which you're basically modeling out the cash that's going to come in to those securities. So when you start to see that, you're basically the lower mark to market is basically like the realities of how the market is pricing things. And in this example, it's marking to market. A lot of what happened with Silicon Valley Bank was they had these lower fixed interest rate investments. And so as interest rates rose, those investments were worth relatively less. And so that mark to market is a little more simple, where you're basically saying, okay, it was worth this, but relative to what you can borrow money at now, it's worth that much less. So yeah, I think that it is hard to say like what the incentives are, but often other banks and asset managers know exactly how much trouble like some of these smaller places that don't have the same technology to mark to market quickly or accurately. So I think that's how a lot of this stuff ends up even coming to light. It wasn't really anything like, as I recall with Silicon Valley Bank, there was a headline about Peter Thiel pulling his money out and like some of these other people, and that was when it snowballed. And I imagine, this is speculation on mine, but I imagine another bank that Peter Thiel did business with clued him in that the asset base wasn't as stable as it was, and then he was the headline, but I imagine it was a lot of people that were pulling their money out.
So, with all this stress in the banking system and the lagging effects that interest rates have, is there any way to explain how the Fed is still raised rates by a quarter of a basis point?
Oh, I think that like I actually wrote about this in one of my newsletters last week, in actually the biweekly one. But yeah, I was wondering that same thing, but then I read a very good article that I shared that basically said, well, the market already baked in 80% were betting on the 0.25% raise. And I would think Powell would like to raise rates for as long as physically possible. Like I think he's going to be forced to stop raising rates in the next meeting, and that wouldn't be his preference because of this turmoil. So I think Powell was probably looking at like, hey, I can get away with this one because the market's already expecting it. And it did prove to be true that it didn't like, it hit, and it did look largely baked into the price. If anything, Friday said that it was expected. So that's more of what I think it was, that he knew because the market was already expecting that it wouldn't cause that much damage. And you might say we'll have to watch what the bets are on the next one. But I imagine they're done. I just think with all this stuff, they're going to have to give a lot of reassuring talk. And like their one goal is going to be to make sure more retail doesn't bail on the banking sector or even start shorting the banking sector and regional banks themselves. So I think they're going to want to do a lot to make sure that the problem is over. And I think if it was closer to a 50-50 like bet for this one, I would think that they wouldn't have even raised it one more time. But I think with such a strong indication, that's why they did it.
I think I saw the future markets are now actually projecting them to cut rates this year.
They have been. Yeah. I talked about that in one of my newsletters, and it is a very weird thing that's going to be figured out later on in this year. And like they're consistently betting that. So I would think that means it's going to happen. Like I would never I'm going with the market and what they're betting almost universally. That's what I've learned. If there's like an agreement of like, especially I would say bond markets, bond investors, and like a lot of people don't really know the difference between like fixed income investors and equity investors, but there's actually a huge difference between them. And most people don't know that many fixed income institutional investors because there's not as many of them relative to the equity side. But they're very conservative, no nonsense, incredibly math based, almost no much less feel. I don't want to say almost no feel, but much less feel than say like a long short non-quantitative equity investor. So like if they're betting interest rates are going to go a certain way, they've got quantitative reasons for that. And I imagine what they're betting on is that inflation is going to cool, and that that's going to cause the drops. Because like Powell has said that he's very data dependent consistently. So I think he's keeping up with the strong talk and saying he's data driven, because he's not going to say he's going to cut rates before he actually sees inflation go down, because it benefits him zero to like hint to that. But I think that's basically what we're seeing. We're seeing the market, like the bond market's betting on that, and knowing if inflation comes down, he'll start cooling on the rates. But he's obviously not like say that for the reasons that we discussed. But yeah, that would be my bet, because it is going to be real rough if inflation keeps up and he doesn't cut rates, because like that's the opposite of what we're talking about. None of that is being baked in to equities right now, which is why like I am not like offering any long-term. Like I would be like right now I'm still doing 2 longs and 2 shorts in my letters. Like by the time we get to what I'm much more comfortable is in a bull zone, I might even have 1 short a week or maybe none. But yeah, I would say that right now, that's what I would bet we were heading towards. I bet we're heading towards good inflation readings, maybe even more surprisingly strong jobs readings. With both of those together could rally the market. You know, basically there's going to be less of a macro hit than some people are forecasting. But the other side is if it doesn't go that way, run for the hills on your longs, I would say.
So you think the market is pricing in like a best case scenario almost?
Well, like I'm saying, I don't ever think they do that. Like I think the market is pricing in what they think overall, especially if you're looking at the crowds. Like, but like I would say the best case scenario is what we're talking about, that they're not necessarily pricing in yet, where we get inflation reduction and jobs growth. I would say right now they're pricing in just inflation reduction and, you know, somewhat of a light ongoing recession. Like, but if we get inflation reduction and strong jobs, then I think that's the best case scenario, and we see a quicker rally out of the bottom. But there's a whole other circumstance, like I'm saying, where inflation is more persistent, and that I would imagine to the severe downside.
So far earnings for companies have been so resilient. Do you attribute that to anything? Is it the money supply being so much higher? It's just people meant the jobs being stronger than we believed. What do you think that caused that?
So, you know, it's funny. I was talking to a friend who was let go of Google last week. Well, he wasn't let go last week, but I was talking to him last week. And I was originally in my newsletter a few weeks ago, I wrote about how like earnings were surprisingly strong, and maybe people should take like a market bottom more seriously because of that. And that there were it looks like a lot of effective cost cutting measures. And I think sometimes people forget, like they just hear recession and they forget that like at the end of the day, stocks go up from earnings. So, you know, and ultimately profits. So yeah, sales could be down, but if companies have done enough to cut their workforce and get their costs in line, we could see a less severe you know, recession in terms of the actual stock market, which sucks. And I always say that this sucks, where it's just like we could see a longer recession and the stock market could be like done and rallied and all the thing. And that obviously is not what you want to see at all. So I want to give that disclaimer. I wouldn't be particularly excited about that. But better than a scenario where they both go down. But I would say the thing I learned from talking to him, he was like, the week after people got laid off, the first time, he's like, I've never seen anybody work. Everybody was working hard. Like he felt like people were getting like a little like lazy, like from like sucking off the Google teat that they all were. And then like everybody got more done. And that's just an interesting way to look at earnings and productivity, because everybody thinks about like cutting the workforce, right? And obviously that's a cost savings, even though, like as he pointed out, that's not really a cost savings until down the line, because of, how much they had to pay everyone. But obviously models are built on like 5 year or longer, like discounted cash flow models. So cutting now, people are going to start building into their models immediately. But that was something that I didn't think about, where I was like, yeah, maybe a lot of these companies, people did get lazy. So like part of earnings increasing could just be like more productive workers that all of a sudden like thought about their job safety for the first time in a very long time.
That's a really interesting note. And now they don't even have to just compete with people, they have to compete with AI.
Yeah. Yeah.
So we'll see how that affects these big companies in the future.
Yeah, yeah. I mean, I think it was the other people getting fired that lit, that lit a fire to their asses. But like, yeah, I think that that's a very good point. Um, that a lot of these people, um, there's a lot more to think about now, and I mean that's a whole other conversation about like about that aspect to it. But you know, one of the things I follow very closely on that note, I was like just checking on our time. Um, One of the things I follow very closely is DeepMind and Jeff Hinton, who was the founder of DeepMind, and Google obviously acquired them. And one of the things that's really interesting about ChatGPT, I mean, it's a great plan, it's a great model, and I would call it more of a data exploration and filtering framework, right? Um, DeepMind, like they built this really cool thing called uh, Alpha Zero. That was the one that started, or sorry, Alpha Zero, which built AlphaGo, which was the thing that beat everything at Go. And then they rolled out this thing Mu Zero, which was the next generation of it. And that's the thing that actually could like that for the first time didn't have to learn games. Basically, before they were teaching it rules. And Mu Zero was the first system that just essentially watched billions of games and learned. Well, obviously did that relatively quickly because of their unlimited computing. And that was a whole other level of AI. And I say this story and Jeff Hinton leaving because that's the first thing that really frightened me a little bit, because like I don't really care that much about what Microsoft is doing or OpenAI. Like I like that as like a brain is not the most advanced brain that's out there. But Google feeling like, and I think this is why Jeff Hinton quit, Google feeling like they're behind and maybe taking some of the like training wheels of something like Mu Zero and just like putting it out into the world, that to me is scary, and it's significant that Jeff Hinton said that's enough for me because I want to be able to talk honestly about this. I'm sure he left a lot of money on the table to be able to do that. And yeah, I mean, there's one side where it's like, wow, I'm excited to see what a brain like that could do, like to make our lives easier when Chat GPT is like, nothing compared to that in my estimation. But it's also scary on the other side. And Hinton is one of the most brilliant minds in AI in the world. And if he's free, if it's enough for him to quit his job, that's something that starts to scare me a little too.
That's a really interesting point because right now it seems like the general consensus is that Microsoft is winning the AI race with OpenAI. But it sounds like from what you're saying is that Google has the best technology. They've just kept it behind closed doors almost.
They've done what a responsible like entity that respects AI should do. But now like they feel behind, to your point. Everybody's talking about them, and now they feel like they for the first time ever, I think they feel like that they might have to catch up. And that's why I think Hinton quit. Because I think they're starting to explore applications for Mu Zero that he probably didn't approve of. And that would be my guess. He was very vague. He just says he wants to talk more about it. But I imagine he's going to look for some of those. I imagine he left to look for some of those products to be released to be able to warn people about them. That would be my guess. Because he hasn't said that much of note since leaving, but maybe he's planning to, say a lot more. But yeah, I think that like that's like if we look at like the AI apocalypse, I believe it will ultimately be Microsoft. Like Microsoft, who fired the first shot, like who scared Google. I'm much more concerned about whatever Google is going to put out there than what Microsoft would. Although I think OpenAI is a great idea and a great team, like nothing performs anywhere close to MuZero right now. And I believe, I mean, there was some weird stuff with Google and the government, but there was one government contract, and this is why I don't really like. I think we were going to talk a little about some of these stocks, and we can do it now. That's a good segue to maybe close up and see if we have any questions. But yeah, Google dropped a government contract, I think about a year ago, and it was very vague in the circumstances, and Palantir grabbed it pretty quickly. And I imagine some of the conversations might have centered around using something like MuZero and Google not being comfortable with that. But I don't know, do you have any, are there any questions you have there, or should we go into some of the stocks that we kind of talked about?
I don't have any questions right now. I just let them know if they want to have any questions, they can comment it. But yeah, we could go into the stocks right now.
Yeah, I think you had a few that you wanted to go through. And Palantir actually reminded me
Mhm.
that Palantir was actually in our list here for a bit, but let's see what happened to them. Yeah, we don't necessarily see big bets on them in the long-term options markets, and that wasn't always the case. But yeah, it does definitely look like we saw a bit of a dip um in that option sentiment. Towards the end of the week, we were seeing some definitely higher peaks. Social sentiment looks like it stayed pretty high, which is obviously good. But I always like to look at them both in tandem, and like kind of hovering below 80 is not that great. You'd want to see a stock that's that hot in the social sphere, have higher numbers than that to get very excited about it. Um, yeah, upside breakout. Nothing. None of these are trending that interestingly. What's another stock that you had? I think you said
PayPal,
Unity, right?
Unity, yep.
And Unity I've looked at here and there, for sure. Um,
So Planter
ooh,
reported today after hours.
yeah, this is some better fundamentals here. And it's actually interesting to see such a low market similarity. That shows that people are trading it very differently. And yeah, we definitely are seeing some good trending, and like those are some good highs. We did see a pretty big low, I guess, on May 5th. But those are some nice peaks for it. And definitely, I mean, we haven't really seen any good spikes in social sentiment, which especially leading into earnings, I wouldn't read that much into. Um, but yeah, upside breakout and downside breakout, not really showing. I mean, I like seeing kind of like lower, like even with some peaks. But yeah, I would say that this one, like versus Palantir, like especially with that 62 growth, could be something that we do see a good, report today on. And I do like that net option sentiment, but since it's been fixed there and hasn't been really making any moves. Um, I would say this looks more bullish than Palantir, but nothing too great.
All right, two more. PayPal, we could look at.
Let's take a look. Ooh, I've definitely seen it be way more. Those are very low. That just means people aren't really betting that strongly in the options markets, one way or the other on it anymore. Um, but yeah, option sentiment, I mean, obviously it looks like it's hovering lower, like we are getting some higher peaks on it right now, which could bode well. Um, and social, we're getting some action, but like, yeah, I would say of these three, Unity looks the best, but like, yeah, I generally don't like, oh,
I guess
I generally don't really like to see, um, stocks that have like such a low upside breakout.
I guess anything in finance is just being viewed as risky currently.
I think that like, or Or you might say because there's like, we saw some other stocks that obviously had like some big bets against them. I would say maybe people are just like staying away. Like that's what I would think for PayPal. Like people don't necessarily think they have bad assets. I just think that like from this, it looks like nobody's got a strong read on how hard it's going to hit them, especially with the huge credit crunch. Like I don't know if we've talked about this before, but either way, like I know people are aware of this. There's more personal debt like right now than there's ever been. And that number is like going up uh like pretty strongly. So yeah, I would say that people don't like, especially with all the personal debt they deal in, nobody wants to take a strong opinion on that one way or the other. All right, you had one more, right?
Yeah, last stock I want to look at was JD.com.
I'm a Chinese company.
Yeah.
I don't like, China's very hard for me right now. But that does look like a very solid trend in net option sentiment. The other ones kind of stayed at the same level, but this one since April 25th is went from kind of like the beginning of the sample to 60s and then the 70s and then more consistently in the 80s and even a 90. That, yeah, this is definitely more of the trends I like to see in a company that like, maybe hasn't quite broken out yet, but could have the potential to.
Oh, they
But
haven't.
again, I give the caveat on China that I don't really like China very much right now.
Yeah.
Too much uncertainty.
Yeah, so I don't see any questions in the chat, so I guess we were thorough in our analysis and everything we talked about Prospero. Is there anything else we want to talk about today?
No. I think we're probably good, right?
I think so. I think this was a great first edition of the Prospero weekly meetings at 11 a.m. Hopefully next week we can get it on Prospero YouTube as well. You guys can check that out if you're watching this. And yeah, I think we're good besides that.
All right. Thanks a lot.
Thanks, George. I'll see you next week.
All right. Bye.